to The Dirt on Organic Farming, a podcast from Oats, the Organic Agronomy Training Service. This season, we are answering all those burning questions we know you have about crop insurance for organic farmers. Yes, we know it's a podcast about crop insurance, but we're going to keep these episodes short, lively, and accessible. Heck, you might even enjoy listening. I'm Nate Powell-Palm.
And I'm Mallory Krieger.
And we're the hosts of The Dirt on Organic Farming.
In this episode, should I be looking into whole farm revenue protection? I have been looking into a program called Whole Farm Revenue Protection, or WFRP. What makes this program unique is that if you're a farmer who produces multiple commodities, produces commodities that aren't traditionally covered by crop insurance, or for whatever reason you're struggling to make crop insurance work for your operation, this is a form of crop insurance that covers the entirety of your operation rather than a single crop. Nate, I'm curious, have you ever used this program on your farm?
You know, Mallory, I personally have not, but I have worked with dozens of organic farmers who have, from barley farmers in Idaho up to corn farmers in Michigan. This is a really commonly used program that has a lot of value to a lot of different types of farmers. So with my crop insurance, I have to get each crop insured separately, and there are only certain types of crops that are covered. Whole Farm Revenue Protection, WRFP, will kind of bundle up your whole farm and provide you with one policy.
Exactly. So to learn more, I called up Webb, who travels around the country educating farmers and insurance agents about whole farm revenue protection.
My name's Lane Webb. I work for the Risk Management Agency as part of the Department of Agriculture, the U.S. Department of Agriculture. I'm in the Loss Adjustment Standards branch. However, I am the team lead for the Whole Farm program. I've been on the program since its inception. I've been with the agency now a little over 9 years. I retired from the Air Force in 2011 after 21 years of service. And I'm just a career federal employee, just out there trying to do my best for the public.
Lane kicked things off by giving me a brief summary of what whole farm revenue protection is and where the program came from.
It is a program developed as a part of the 2014 Farm Bill. It's basically a predecessor to the old Adjusted Gross Revenue Program or Adjusted Gross Revenue Light Program. I won't go into that, but it is, of course, first offered in 2015. It also includes microfarm, and I'm sure we'll talk about that here in a little bit. But it's a product offered through the federal crop insurance by the Risk Management Agency. It provides protection against the loss of insured farm revenue, mainly due to unavoidable natural causes of loss that occur during the insurance period, and it insures all commodities or crops, if you will, grown on the farm under one insurance policy. There's very, very few limitations to what we can insure. The exclusions are timber, forest products, and animals for show sport or pets. Those are the exclusions that we have within our policy. Any other commodity that can be grown on the farm is insurable under the whole farm program.
So if you have a really diversified farm or are growing specialty crops, it sounds like this would be a really good program for you.
Yes, and Lane gave me an idea of the demographics that whole farm revenue protection is geared towards.
Our target markets are those that grow specialty and or organic crops, of course, and that includes crops, commodities, and livestock. Also, we market to, or the market would be to local, regional, farm identity preserved farms, specialty, and direct marketers.
Another thing that farmers probably want to know right off the bat is how much it covers.
Of course, whole farm is developed with a higher revenue limit in mind. That program covers up to $17 million in revenue, whereas the microfarm policy, a offset of the whole farm program, is limited to a $350,000 approved revenue limit. Whole farm post-production costs are not included in your expected revenue or your history, whereas microfarm post-production and value-added costs can be included in your history and your expected revenue.
Interesting. Post-production costs. I haven't heard of that being included in crop insurance coverage.
Yeah, Lane gave me some more context on what post-production costs entail for the microfarm program.
So post-production is basically anything after harvest. So a producer that grows strawberries, right? He grows strawberries, he cuts them, he has to wash them, he has to box them, or put them in a little clamshell, whatever they got to do. All those things can be kept in. Value added, on the other hand, is some of these folks are farmers market type folks. So they may take their apples or their cherries and make pies or jams or jellies, things like that. So they don't have to take any of that stuff out. The jars, the processes and all that stuff can stay in it. So if they're selling a jar of their own apple preserves in their farmers market, then whatever that cost is, they can leave it in as revenue, right? Now, for whole farm, it's a completely different story. You got to back all that stuff out because it's not allowed to be insured under the whole farm program. You got to back it out basically to the cost of the fruit or the commodity.
Got it. So if I make, say, Nate's famous pancake mix with the wheat that I grow on my farm, I can include the cost of the mix in my coverage.
Yes, it's a pretty good option for those small producers who are making some of those value added products and selling them at farmers markets.
Here's what I'm wondering though. If coverage for every farm looks different because it's based on the particularities of that farm, how is coverage measured?
So, whole farm revenue protection is actually based on farm revenue, which means you need revenue history. Lane explained more about this.
The only history that we require, or the policy requires, is to have farm revenue history to be eligible. Now, for whole farm, there's a 5-year requirement, 5 years of tax records for that establish farm revenue, right? You have to actively be engaged in the business of farming, if you will. And there's some exceptions, beginning farmers and ranchers. We have some provisions out there that allow less than 5 years, typically 3 or 4 years, to build a 5-year history. Now, for microfarm, we only require a minimum of 3 years of history in order to be a part of that program. Now, that doesn't mean that you have to have a history of growing the crops you expect to grow this year. It's a comparison of historical numbers versus expectations for the current year. So that gives the ability for whole farm and or microfarm producers to go out and try something new. If you want to rotate to a new crop or a crop that doesn't have a whole lot of history out there, there's a lot of specialty crops, a lot of cultural type crops out there, that nobody else is growing, but whole farm and our microfarm recognizes that, and we have the ability within the program to determine some yields and prices based on some information that we may gather, or the producer's information, to set up that expected revenue piece.
Lane also mentioned that if a farmer has a contract that qualifies as a marketing contract under the whole farm revenue policy, then they can use that price. And the deadlines for whole farm revenue protection are the same as for contract pricing.
So, Mallory, I'm a wondering, can farmers have other policies in addition to whole farm revenue protection?
Yes, but it's a little complicated.
Under a whole farm, if there's individual policies available for any specific crop on your farm, you're able to buy an underlying policy, a federal crop insurance policy to go along with it. It has to be at the buy-up coverage, and we do give you liability credit for those policies, so you're not paying double insurance. The only downside, I guess, to that is any payment or indemnity paid out on that policy is counted as revenue for the whole farm policy. Microfarm, unfortunately, individual policies are not allowed under the microfarm policy. The biggest question we do get is, can a producer have NAP, which is the Non-Insured Disaster Assistance Program through FSA? Yes, NAP works with whole farm and microfarm. We have procedures that take care of that payout as well.
So, the key to whole farm revenue protection is that it is flexible and can accommodate a wide variety of farms and crops.
On the one hand, that's great. That whole farm can really account for all these different scenarios and provide an insurance solution for farmers who might not have another option. But I think on the flip side, whole farm does have a reputation for being, shall I say, paperwork intensive.
That is true, and Lane explained what documents are needed for a whole farm policy.
For sure, they got to come up with their tax records. Schedule Fs if they've got them. And then if they don't, of course, then they got to have enough records documentation to create what they call a substitute Schedule F. And then if their entity or their structure is complicated, then they may have to bring in some more documents to kind of verify or justify their entity structure, if you will, for eligibility requirements. Other things that they may have to have is information about commodities that they're going to grow on their farm for the current year. What are they planning on growing? And if it's for a whole farm policy, then, you got to come in with some expected yields and prices, or at least some information so you and your agent and the company can work together to come up with that yield and price for that expected revenue. Any kind of past production records, sometimes the producers may be asked to come up with that stuff up front, but typically this year was one of those things we kind of changed. It's like, the expectation is not to have it up front, but they got to have it available, right? Because specifically at claim time, all that's going to be asked for, type stuff, to make sure that your expectations were on point with what you could prove, if you will.
Something that I would be really interested to hear about from a farmer's perspective, whether they feel that this paperwork is prohibitive or if it's fairly doable.
Agreed. Lane pointed out the importance of having a good crop insurance agent for that very reason. He also mentioned the RMA is really open to feedback on the program and has made changes in the past based on input.
Whole farm and or microfarm is not a program you can walk into your agent's office on sales closing date and expect to just get signed up. I think the work involved, especially for a first year insured, there's some work that has to go into writing that policy. Just to kind of add to that, we typically hold meetings, at least with our insurance providers, and based on their feedback, that's where a lot of these changes come from, even under the whole farm program. Of course, this year we did the RMA Roadshow, which focused on whole farm and microfarm. So we're out there, we're actually, again, getting tremendous feedback, on some of the changes we may need to make moving forward to make it an even better program.
So Lane is out there getting feedback from farmers and figuring out how to make the program work better for them, which is awesome. But like you said, we got to hear it from a farmer. So I reached out to Andy Getting to learn how whole farm revenue protection is working for him.
Name's Andrew Getting. We farm near Sanborn, Iowa. We raise corn, soybeans, oats, and strawberries. Been organic for 6 years and continue to transition more as we go. We have used whole farm revenue protection for 5 years on our farm.
Andy shared why he uses whole farm revenue protection on his operation.
Well, the way I understand it is, instead of tracking yields and prices, the whole farm policy looks at your operation as a whole. This allows our operation to get a set revenue guarantee for our crops. And my main concern as a farmer is, I want our farm to have cash flow. So that policy allows us to do that. Ultimately, this product gives us coverage for our strawberries, and we didn't have anything for them before other than NAP through FSA. We've had trouble, with revenue with our strawberries in the past, ultimately. And so that's why we chose to look into this policy.
Andy mentioned he has tried other forms of insurance, but they didn't quite cut it for him.
We've continuously had hail coverage, but there's such a small window where the policy would actually cover us. And it seems like it doesn't line up well with actual loss. If it would hail and the fruit would be green and they'd come out at the time of harvest and look, a lot of the time the damage wouldn't correctly reflect the loss. And so we've had trouble collecting on that. And a lot of the pricing and things, whether it's hail or not, a lot of the pricing just isn't the same as what we set at our local market for our products. And so the payments just don't seem to line up with what our expectation is.
So it sounds like for a farmer like Andy, it wasn't just one option, but really the only option he felt he had to get the coverage that he needed for his farm. I'd love to hear how he felt about dealing with the documentation.
Yeah, Andy shared what the paperwork looked like for him and whether he feels it's worth it.
You need 5 years worth of Schedule F tax forms, along with some supporting documentation of your yields and prices. We had to provide that for our strawberries when signing up because it wasn't corn, soybeans, or oat production. Also, since we contract our grain, we had to provide them with a contract along with the application to insure our crops at the contracted price instead of the insurance price. And I think this next year, some of our contracts were better and some of them weren't. So you kind of have that flexibility, as I understand it. And then when signing up, we go through and notate what we're planting in each field for the initial farm operation report, so it will correctly reflect our income potential for the next year. So that just gives me peace of mind when sitting down with my agent, that I can know that they know what I'm planting where and what the potential for that each field is. So that's, I feel like, a really good option. And the documentation we provide just simply gives us a good picture and what risk there is, and as a whole, and then how our policy can mirror that risk to support our operation for that year. We're raising higher valued crops with little protection, so it's just absolutely necessary for us, especially with these weather events that we're having. We had a year in 2018 where we had a complete loss, and NAP paid us very little. And that was a good learning experience for me, and ultimately forced me to look in a different direction for insurance. So yes, it's definitely worth it in my mind.
It's awesome to hear that Whole Farm Revenue Protection enabled Andy to have an insurance policy that really worked for his farm. I know that feeling of being undercovered. It's hard enough to get a crop out of the field, and if you don't have good risk mitigation, it can be really scary to be in this business.
I hear you. I asked Andy if there were any things that he would change about the Whole Farm Revenue Protection Program, but he was more focused on the availability and accessibility of information about the program and how to utilize it.
I simply think, for improvements that can enhance the policy, more education on the policy for farmers, more availability to information from the insurance companies on what does whole farm revenue do for a farmer, and especially farmers raising specialty crops and organic farmers. And simply just more agents being willing to take on the challenge of signing some people up for the policy.
Now, we may be hammering this in, but this just keeps coming up again and again. We need more insurance agents who can support organic operations that don't fit easily into traditional crop insurance programs. Andy managed to figure it out, but I'm sure there are so many other farmers that could benefit from more information and support with whole farm revenue protection.
Absolutely. Andy had to spend a lot of time looking for an agent that could really support him. He brought home the importance of having more agents that know about these and other crop insurance options.
5 or 6 years ago, when we were looking for a way to cover our strawberry farm, especially, we ended up having to fill out a lot of paperwork and actually have someone come out from the company to help us fill out the application, because our local agents knew nothing about it, nor had anybody on the policy. And we've gone through several different agents and different agencies to try to find a good fit. And I'd say if there's been a frustration with the policy, it's been finding someone with the knowledge that we need to have the security that we want. That's probably the thing I've struggled with as an operation, is just, we want to transition crops to organic, raise more crops, but, how can we keep our cash flow, our bottom line in the black yet in doing so with these extreme weather events? I think we found an answer to that.
This has been The Dirt on Organic Farming, a podcast by the Organic Agronomy Training Service. OATS provides training to agronomists, advisors, and crop consultants so that farmers will have better access to reliable, science-based advice for their unique farm operation. Special thanks in this episode goes to Lane Webb and Andy Getting. This episode was produced by Michaela Elias. For more information, go to www.organicagronomy.org. OATS is a programmatically independent consortium that is fiscally sponsored by the Organic Trade Association. OATS is supported in part with funding from OTA's membership companies. Season 2 of The Dirt on Organic Farming is made possible by a funding partnership with USDA Risk Management Agency under award number RMA 22CPT0012393. I'm Mallory Krieger.
And I'm Nate Powell-Palm.
Till next time, thanks for listening.